Good morning. I call this hearing to order. For many Americans, a college degree is an important goal that can mean a lifetime of better earnings and opportunities. However, this goal has come at a higher price. The cost of education has risen significantly while the job market has weakened, straining a generation of Americans seeking to establish themselves in the broader economy. Student loan debt now stands at over $1 trillion and is second only to mortgage debt as the largest form of debt in the country. Student loan balances have almost tripled since 2004, and an alarming one-third of borrowers are delinquent on their loans. Last year, nearly 8 out of 10 students in my home state of South Dakota graduated with student debt. These rising debts reach beyond individuals and impact many sectors of the economy. High levels of student loans mean many put off buying a home or never become homeowners at all. Student loans make it harder to start small businesses. Student loan payments often take priority over retirement savings. And rising student loan balances in states like South Dakota make it harder for graduates to stay in rural communities. While most student loans are federal, private loans make up $150 billion of the market. Private lenders allow many students to attend college who would not otherwise be able to afford it, and may sometimes offer better terms than federal loans. However, nearly 1 million borrowers are in default on their private student loans. And while federal loans offer flexible relief during periods of hardship, most private student lenders do not offer the same options for struggling graduates. Our witnesses today represent the federal agencies responsible for ensuring that lenders balance sound lending principles with appropriate measures to avoid default. I look forward to hearing your testimony on guidance you provide to lenders and what limitations lenders may face in providing relief. The CFPB has been very active in private student loans, recently publishing a proposal to oversee large student loan servicers and a report on affordable private student loan repayment. I'm interested to hear from the CFPB on both of these efforts. Next week, on July 1, millions of students face a doubling of the interest rates on some federal loans. I urge the regulators to be vigilant in monitoring growth in the private student loan market that may result from changes to the federal student loan market. It is critical that regulators respond quickly to marketplace changes and that consumer protections are safeguarded when demand rises. With that, I turn now to Ranking Member Crapo.
Thank you, Mr. Chairman, for holding this hearing today. Student loans play a vital role in the lives of many students and their families across this country. The loans help maintain a strong and educated workforce by ensuring that all Americans can have access to higher education, regardless of their financial circumstances. Recently, the New York Federal Reserve reported that student loan debt has risen to become the second largest household debt burden behind mortgages. The total outstanding student debt was $986 billion in the first quarter of 2013. Just 9 years ago, that number was $240 billion. Several factors have contributed to this student debt explosion over the last decade, including college tuition rates that have significantly outpaced inflation, and a record number of students and employees opting for school in light of the very tight job prospects in the market. When discussing the student loan market, there's considerable confusion as to who is making the loans and how the loans are made. According to the CFPB, 85% of the total outstanding student debt is in federal student loans offered through the Department of Education. That is roughly $838 billion. Private student loans, the subject of this hearing, make up 15% of the outstanding debt, and that market is expected to shrink even further. A recent Standard & Poor's report noted that new originations for federal loans occupy roughly 94% of the market, while private lenders originate the remaining 6%. Much of the contraction in the private lending market is due to the restructuring of the Department of Education loan programs in 2010 to virtually eliminate private lenders. Other important considerations include the fact that federal loans default on average 3 times as often as private loans. Federal loans do not undergo an underwriting process, and there is almost limitless spending for borrowers who take out federal loans for graduate school. With respect to private student loans, one concern I often hear is that banks don't offer enough borrower relief options. In the testimony submitted today, it appears that prudential banking regulators and the CFPB are offering conflicting guidance on borrower relief options. The CFPB is pressing for more borrower relief. However, the prudential banking regulators are concerned with how modified loans affect a bank's safety and soundness, as well as whether they violate accounting rules. Lenders have stepped up and expressed their willingness to help more troubled borrowers and cite that loan modifications may benefit both borrowers and lenders in certain circumstances. Today, I hope we can get a better understanding of the obstacles that face us directly from the regulators. I also would like to hear about how the regulators are working together to resolve this conundrum of providing student loan relief while not endangering the safety and soundness of the system. Finally, since the vast majority of student loans are made by the Department of Education, we need to acknowledge that the Committee on Health, Education, Labor, and Pensions has a critical role in determining whether the Department of Education's student loan programs are helping the situation or binding students and their families into too much debt. I know all my Senate colleagues want to find a solution to ease the burden on our young people. Mr. Chairman, before we conclude, we received a letter from the Consumer Bankers Association and a letter from the Financial Services Roundtable regarding student loan issues, and I would request that both letters be entered into the record.
Without objection.
Thank you.
Thank you, Senator Crapo. Are there any other members who wish to make a brief opening statement?
Mr. President.
Senator Reid.
Thank you, Mr. Chairman. Thank you very much for holding this hearing. And we are reaching a tipping point with student loan debt, as you've and Senator Crapo have illustrated, particularly as we approach July 1st with the potential doubling of loans on students who have the most need in our country. Student loan debt, as both my colleagues have indicated, is really the next big financial crisis, and it could have a lasting impact on our economic growth and the perspectives for coming generation. We've seen student loan debt rise throughout the recession, even as other household debt has fallen. And student loan debt, as my colleagues have indicated, is now the second largest outstanding balance after mortgage debt with respect to households. And this is affecting the life trajectory of generations of Americans, the young people today, and if we don't do anything, even their children. Our students are caught between a rock and a hard place. The job market increasingly demands post-secondary education. At the same time, college is getting much more expensive. There's been a major cost shift in higher education. Costs have gone up. State support for public institutions has gone down. And as a result, tuitions are rising, in fact, exploding. In the federal student aid program, 68% of federal student aid is in the form of loans. And I have the privilege of holding the seat held by Claiborne Pell. When Senator Pell introduced the Pell grants back then, the mix was much different. In fact, I believe it was 80% grants and 20% loans. And we have turned the whole thing over on its head. In fact, many of my contemporaries were the beneficiaries of that wonderful 80% loan to 20%, 80% grant to 20% loan effort, and we're not keeping up with that at the federal level. We have to keep these loans affordable. Low interest rates is part of the solution, and again, it is just distressing many of us that We're on the precipice of doubling the subsidized rate from 3.4 to 6.8% in just a few days. Ironically, as we increase the rates, and my colleague from Massachusetts, Senator Warren, has pointed this out again and again, the federal government is making about $50 billion this year on their loans and expected to make $180 billion between now and 2023. So there's a lot of money. It's just not getting to the young people that need it and their families. We've got to work on both sides, and we have to recognize that we have to be back where we were, I believe, in the 50s, 60s, and the 70s, where we're actually using federal resources to help people get to college, not using students to pay down the debt. And many of my colleagues are suggesting that we do precisely the latter, not the former. So I look forward to today's testimony on the broader issue of private loans, but we really have a crisis that is before us. Thank you, Mr. Chairman.
Is there anyone else? Senator Brown.
Thank you, Mr. Chairman. I appreciate the Senator Reed's words. My wife is the daughter of a utility plant maintenance worker and a home care worker, and she graduated first in her family to go to college from Kent State 30, I won't say how many years ago, 30 plus years ago, with student debt of about $1,200. And I think that tells the story that he mentioned. Thank you to the witnesses, and thanks, Mr. Chairman, Senator Crapo, for holding this hearing. In November 2009, I introduced legislation to create a private education loan ombudsman. These provisions were part of Dodd-Frank in 2010. Some 3.5 years later, it's gratifying to see the great work that CFPB's first student loan ombudsman, Mr. Chopra, is doing with this office. Thank you for that. Speaking out about issues helping borrowers get real relief. About a year ago, my subcommittee held a hearing on private student loans where Mr. Chopra and I discussed the discrepancy between the low rates at which banks borrow and the interest rates that they charge students, something that Senator Reed and Senator Warren both talked about. The example, the nation's largest student loan lender borrows at an average rate of 1.45%, while the average private student loan borrower is paying more than 5 times that amount, some 7.9%. Mr. Chopra's testimony then noted that notes that the increase in private student loan lenders' interest margins, quote, may demonstrate a lack of competition as well as an opportunity for more efficient private capital participation. The president of the nation's largest student lender said in January the margins here are really a function of alternative financing opportunities. We're making loans to parents and students, family education loans. Their alternatives are fairly limited. Today, I am proud to announce that my fellow member of the Banking Committee, Senator Heitkamp, and I, along with Senators Durbin and Murray, are introducing legislation to create opportunities for borrowers to refinance their private student loans. The Refinancing Education Funding to Invest for the Future Act, or REFI for the Future, would authorize the Treasury Secretary in consultation with the Education Secretary and the CFPB to create a program to encourage competition and spur refinancing of private student loans. The most indebted student borrowers are the most likely to have private student loans. Of the $1 trillion that Senator Crapo mentioned in student loan debt, only about 15%, but that's still $150 billion is in the private student loan market. It's something we can do something about. Senator Heitkamp's and my legislation will help to do that. Thank you, Mr. Chairman.
Does anybody else? Senator Heitkamp.
You know, a couple of months ago, I hosted a housing tour across North Dakota. We have an acute shortage and affordability issues due to our economy as things grow. At the roundtables that I conducted, one issue came up over and over and over again, which is that young people cannot get entry into the market because they're not bankable. And they're not bankable because they're carrying thousands and thousands and thousands of dollars of student debt. And families talk to us every day and say, how come at a time of record low interest rates, we're paying 8, 9, 10% on our student debt? We cannot continue this. And we know from massive credit card interest that if we do not figure out a way, they will continue to pay the interest and never get out of the principal debt and never be bankable, never be able to get a loan to build a business, be entrepreneurial. This is crushing the future of our economy if we don't deal with it. And this is a small point, obviously not the big part of student loan issues. We're concerned about the rates, but we're also concerned about giving those people with private loans an opportunity to refinance just like you would if you had a mortgage. And so I want to applaud Senator Brown for the work that he's done. I'm proud to be on this, and I want to thank the chairman and the ranking members for holding this hearing. This is an issue that won't go away. It is an issue that we will continue to work on until we know that we have secured a viable future for American families, and they won't be, buried under with student debt. Thank you, Mr. Chairman.
Thank you all. I want to remind my colleagues that the record will be open for the next 7 days for opening statements and any other materials you would like to submit. Now I will introduce the members of the panel. Rohit Chopra, did I pronounce that correctly?
Close enough.
Yeah. Is a student loan ombudsman at the Consumer Financial Protection Bureau. John Lyons is a senior deputy comptroller for bank supervision policy and chief national bank examiner at the Office of the Comptroller of the Currency. Todd Vermillier is a senior associate director for banking supervision and regulation at the Board of Governors of the Federal Reserve System. Doreen Eberly is a Director of Risk Management Supervision at the Federal Deposit Insurance Corporation. I thank all of you again for being here today. I would like to ask the witnesses to please keep your remarks to 5 minutes. Your full written statements will be included in the hearing record. Mr. Chopra, you may proceed.
Thank you, Mr. Chairman, Ranking Member Crapo, and members of the committee for the opportunity to testify today. It is clear that many in Congress are keenly interested in finding solutions to some of the troubling trends in the student loan market. Understandably, many policymakers across the country are seeking to address some of the underlying drivers of growing student loan debt, including the rising cost of tuition. However, it will also be prudent to address the large pool of existing debt owed by millions of Americans. The Consumer Financial Protection Bureau estimates that outstanding student loan debt is approaching $1.2 trillion. While most of the market consists of federal loans, 81% of our high-debt undergraduate borrowers used private student loans. And like a business, a consumer's ability to manage cash flow is absolutely critical to financial health. Private student loan providers generally do not offer this cash flow management option, which is available to borrowers of federal student loans. And for private loan borrowers who default early in their lives, the negative impact on their credit report can make it even more difficult to pass employment verification checks or ever reach their dream of buying a home. While risks in the student loan market do not appear to jeopardize the solvency of the financial system, the difficulties borrowers face when trying to manage cash flow may have a broader impact on the economy and society. We recently published a report on what we heard from the public about these potential impacts. The National Association of Home Builders wrote to the Bureau about the relatively low share of first-time home buyers in the market compared to historical levels, and that student debt can, quote, impair the ability of recent college graduates to qualify for a loan. And when young workers are putting large portions of their income towards student loan payments, they are less able to stash away cash for that first down payment. In submissions by coalitions of small businesses, groups cited a number of factors about the threat of student debt. For many young entrepreneurs, it is critical to invest capital to develop ideas, market products, and create jobs. But high student debt burdens require these individuals to take more cash out of their business so that they can make monthly payments. The American Medical Association wrote that high debt burdens can impact the career choice of new doctors, leading some to abandon caring for the elderly or children for more lucrative specialties. Student debt can also impact the availability of other professions critical to the livelihoods of rural communities. According to an annual survey, 89% of veterinary students are graduating with debt, averaging over $150,000 per borrower. Veterinarians encumbered with high debt burdens may be unable to make ends meet in a dairy medicine or livestock management practice in remote areas. Classroom teachers submitted letters detailing the impact of private student loan debt, which don't always offer the income-based repayment options or loan forgiveness programs. When there was concern about the domino effect of problems in the capital markets, policymakers took action. In 2008, distress in the credit markets led the federal government to enact policies to assist financial institutions to raise capital for student loan issuance. While programs like the ECASLA and TALF were primarily designed to assist financial institutions to originate more loans, understanding them might be useful for policymakers seeking to address some of the market failures faced in this market. In our recent report on student loan affordability, we discussed a number of ideas put forth by the public. I want to briefly note two that might increase private capital participation and market efficiency. The first is spurring loan restructuring opportunities. Most private student loans have few options available for alternative repayment plans. Policymakers might look to provide a path forward for borrowers in distress, creating a transparent step-by-step process that leads to affordable payment terms where monthly payments can match a reasonable debt-to-income ratio and repayment of the loans can be more affordable. This may be helpful to financial institutions as well, who can recognize a higher net present value of loans in distress. The second is jump-starting a student loan refinance market. For borrowers who have dutifully managed their monthly payments on high-interest rate loans, many raise the need for a way to refinance. This approach could give responsible borrowers the opportunity to swap their loan for one with a lower rate. When mortgage borrowers and others see rates plummet, they try to refinance. Responsible borrowers should have that option too. Thank you for the opportunity to share insight on the state of the market, and I look forward to any questions you have.
Thank you, Mr. Chopra. Mr. Lyons, please proceed.
Chairman Johnson, Ranking Member Crapo, and members of the committee, I appreciate this opportunity to discuss the OCC supervisory approach to private student lending conducted by national banks and federal associations. Promoting fair and equitable access to credit, including education financing, is a core OCC mission and one of our highest priorities. Financial assistance is an important means of helping promote higher education in this country. National banks and federal savings associations have a long history with federal and private student lending programs, but they make up just 3% of the approximately $1 trillion in outstanding student loans in this country today. However, the private student loans offered by national banks and thrifts provide an important supplement for many students seeking to finance their educations. For most consumer loans, such as auto loans, the underwriting, structure, and management of the loans are straightforward. The funds serve a specific purpose, and the source of repayment is well-defined and easily assessed at the loan's origination. Student loans, however, pose unique challenges for lenders and borrowers. For example, student loans often require a several-year commitment that extends beyond when the student starts school until repayment begins after the education is complete. Private student loans are usually unsecured, and a significant time may pass between when the lender advances the funds and when that student reaches their anticipated earnings potential. In addition, because the government does not guarantee private student loans as it does federal student loans, many lenders require cosigners to help ensure repayment. Notwithstanding the challenges of private student lending, we expect national bank and thrift lenders to provide flexibility to borrowers when appropriate. For example, lenders typically defer payments until borrowers are in school, and offer grace periods afterward to help borrowers transition to employment. Student loans are the only consumer product with such a transition period. This flexibility reflects the unique circumstances of the student borrower and that these loans truly are an investment in the borrower's future. We also encourage lenders to work with borrowers who experience financial hardship. That assistance may come in the form of forbearance, modification programs that reduce interest rates or change other terms of the original loan, or extended grace periods that go beyond what is permitted in other consumer loans for up to 12 months. The OCC supports these efforts and issued guidance to our examiners in 2010 describing our expectations for managing forbearance, workout, and modification programs.
While the OCC encourages national banks and thrifts to work with borrowers facing difficulties, this does not relieve these institutions of their responsibility to ensure that regulatory reports and financial statements are accurate and representative of the financial condition of the institution. Neither the public nor the banking industry should confuse the expectation for full and accurate reporting as a limit on available forbearance, workout, or modification programs. To be clear, our student lending guidance allows flexibility for lenders to offer forbearance and modification programs, but requires banks to report the volume and nature of these transactions accurately. The flexibility to assist borrowers and the responsibility to report these actions accurately are not mutually exclusive. Together, they promote a safe and sound banking system. My testimony concludes with a discussion of a number of policy recommendations to strengthen student lending. Overall, the OCC supports recommendations aimed at improving the transparency of student loans to help students and their family make better informed decisions. Likewise, we support loan documents and billing statements that are easy to read and understand. In closing, while private student lending is a small part of the available financial assistance in this country, it is an important part, and we encourage banks to work with troubled borrowers during periods of hardship. Thank you for the opportunity to testify, and I'd be happy to answer your questions.
Thank you, Mr. Lyons. Mr. Vermeulen, please proceed.
Chairman Johnson, Ranking Member Crapo, and other members of the committee, thank you for the opportunity to testify at today's hearing. First, I will discuss recent student loan market trends and the portfolio performance of both government-guaranteed and private student loans. I will then address the Federal Reserve's approach to supervising financial institutions engaged in student lending. The student loan market has increased significantly over the past several years, with outstanding student loan debt almost doubling since 2007, from about $550 billion to over $1 trillion today. Balances of student loan debt are now greater than any other consumer loan product, with the exception of residential mortgages, and this is the only form of household debt that has continued to rise during the financial crisis. Since 2004, both the number of borrowers and the average balance per borrower has steadily increased. In 2004, the share of 25-year-olds with student debt was just over 25%, and it stands at more than 40% today. At the end of 2012, the average balance per borrower was slightly less than $25,000, compared with an average balance of just over $15,000 in 2004. Of total student debt outstanding, approximately 85% is government guaranteed in some way, while private loans represent 15% of the market. While federal student loan originations have continued to increase in each year, private loan originations peaked in 2008 at roughly $25 billion and have dropped sharply to just over $8 billion in 2012. In line with the rapid growth in student loans outstanding, the balance of student loans, private and guaranteed, that are currently delinquent has risen sharply, standing at 11.7% in 2012, a large increase from 6.3% in 2004. However, some 44% of balances are not yet in their repayment period, and if these loans are excluded from the data pool, the effective delinquency rate of loans in repayment roughly doubles to 21%. Of the $1 trillion in total outstanding student loan debt, about $150 billion consists of private student loans. In the private student loan market, roughly 5%, or $8 billion, is delinquent. There are likely a number of factors underlying the difference in performance of government-guaranteed and private student loans. For instance, underwriting standards in private student loan market have tightened considerably since the financial crisis, and today almost 90% of these loans have a guarantor or cosigner. The Federal Reserve has no direct role in setting the terms of student loan programs. The Federal Reserve does, however, have a window into the student loan market through our supervisory role over some of the banking organizations that participate in this market. Federal Reserve supervision of participants in student loan market is similar to our supervision of other retail credit markets and products. For large institutions, the Federal Reserve regulates with significant student loan portfolios. Our on-site examiners evaluate the institution's credit risk management practices, including adherence to sound underwriting standards, timely recognition of loan deterioration, and appropriate loan loss provisioning. The Federal Reserve and other federal banking agencies have jointly developed guidance outlining loan modification procedures that discusses how banks should engage in extensions, deferrals, renewals, and rewrites of closed-end retail credit loans, which include student loans. Any loan restructuring should be based on a renewed willingness and ability to repay and be consistent with an institution's sound internal policies. The Federal Reserve encourages its regulated institutions to work constructively with borrowers who have a legitimate claim of hardship. Moreover, Federal Reserve examiners will not criticize an institutions that engage in prudent loan modifications, but rather view modifications as a positive action when they mitigate credit risk. As supervisors, our goal is to make sure that lenders work with borrowers having temporary difficulties in a way that does not contradict principles of sound bank risk management, including reflecting the true quality and delinquency status of student loan portfolios. Higher education plays an important role in improving the skill level of American workers. Due to increases in enrollment and the rising costs of higher education, student loans play an important role in financing higher education. The rapidly increasing burden of student loan debt underscores the importance of today's hearing. This concludes my prepared remarks, and I'd be happy to answer any questions you have.
Thank you, Mr. Vermillier. Ms. Eberly, please proceed.
Chairman Johnson, Ranking Member Crapo, and members of the committee, thank you for the opportunity to testify on behalf of the FDIC on the important topic of private student loans. In today's fragile economic environment with persistently high levels of unemployment and underemployment, many consumers are struggling with debt loads from student loans, both federal and private. We understand the concerns of struggling private student loan borrowers and encourage the banks we supervise to work constructively with these borrowers. While it's difficult to be precise about the size of the private student loan market, it is estimated that as of December 31st, 2011, the market totaled about $150 billion, or 15% of all student loans outstanding. In the 2011-2012 academic year, banks supervised by the FDIC held about $14 billion in outstanding private student loans and originated about $4 billion in new loans. The FDIC supervises private student loan lenders using the same framework of safety and soundness and consumer protection, rules, policies, and guidance as for other loan categories. The Interagency Uniform Retail Credit Classification and Account Management Policy, or Retail Credit Policy for short, applies to student loans as it does to other unsecured personal loans. This policy provides institutions with guidance on classifying retail credits for regulatory purposes and on establishing policies for working with borrowers experiencing problems. Private student loans held by FDIC-supervised institutions are generally performing satisfactorily. They have a past due ratio of just under 3% and a charge-off rate of just over 1.5% per year. While the overall performance of these private student loans is satisfactory, we understand that many borrowers are currently having difficulty repaying their loans, and we encourage the banks we supervise to work with troubled borrowers using the guidance provided by the Retail Credit Policy. The Retail Credit Policy provides institutions significant flexibility in offering prudent loan modifications. Institutions are responsible for establishing their own modification standards within the principles set forth within the Retail Credit Policy. They must also monitor the performance of modified loans to ensure that their standards are reasonable. We make clear to our institutions that we will not criticize banks for engaging in alternate repayment plans or modifications that are consistent with safe and sound practices. In the end, prudent workout arrangements are in the long-term best interest of both the financial institution and the borrower. Under the policies they established, FDIC-supervised banks offer troubled borrowers forbearance for periods ranging from 3 to 9 months beyond the initial 6-month grace period after leaving school. In addition, a number of workout plans are also available to borrowers of institutions we supervise, including interest rate reductions, extended loan terms, and in settlement situations, principal forgiveness. However, it is important that workout programs not leave the borrower worse off. For example, a workout that results in significant negative amortization can leave a borrower deeper in debt. Concerns have been raised that troubled debt restructuring accounting rules, or TDR rules, limit a bank's ability to modify student loans. The TDR rules are established by generally accepted accounting principles which banks are required by law to follow. However, the TDR rules do not prevent institutions from working with borrowers to restructure loans with reasonable terms. The FDIC will not criticize a restructured loan even if it's designated a TDR. We also appreciate the significant challenges borrowers face for refinancing higher-rate private student loans. One of the more important challenges is the lack of participants in the refinance market. The FDIC continues to seek solutions for challenges in the student lending arena. In the next few weeks, we intend to issue a financial institution letter to the banks we supervise, clarifying and reinforcing that we support efforts by banks to work with student loan borrowers and that our current regulatory guidance permits this activity. The financial institution letter will make clear that banks should be transparent in their dealings with borrowers and make certain that borrowers are aware of the availability of workout programs and associated eligibility criteria. We have also formed an internal working group to engage private student loan lenders and consumer groups on these issues. We are discussing our current policies and the refinancing challenges with other regulators to determine whether additional clarifications or changes of current policies may be needed. Thank you again for inviting me to testify. I look forward to your questions.
Thank you, Ms. Everly, and thank you all very much for your testimony. As we begin questions, I will ask the clerk to put 5 minutes on the clock for each member. This question is for the whole panel. If Congress fails to act, interest rates will double on some federal Stafford loans next week. If these rates double, what do you think the impact will be on the private student loan market? What steps are your agencies taking to closely monitor the situation and any related growth in the private student lending market? Mr. Chopra, let's begin with you.
Well, the change in the federal student loan interest rates only impacts future borrowers, so it has absolutely no impact on private student loan borrowers who are currently trying to refinance, trying to pay back those loans. Some industry observers would guess that the change in the interest rates might be a slight tailwind to private loan origination, but I don't expect it to be a huge one.
Mr. Lyons.
I think what you may see in the private loan market is risk-based pricing, which is what they should be doing today, risk-based pricing. And I think you should see that continuing forward. It all is predicated on the competition within the market and what the competitors are pricing as well.
Mr. Bernier.
If pricing in the government space were to increase, we would expect that the attractiveness, the relative attractiveness of the private products would increase. So we would expect growth in new originations. Our examiners would monitor this. They would monitor underwriting standards. They would, as the importance of the asset class increased, their scrutiny of it would increase commensurately.
And Ms. Everly.
I think that, there would definitely be an impact on borrowers of the federal program going forward, as Mr. Chopra noted, with the increase in interest rates. But the impact on the private market, I think, is really unclear. As noted by Mr. Lyons, the private market does engage in risk-based pricing, and so the pricing of the federal loan product is not really a factor in the private loan product. I would add that I would expect that students would continue to try to exhaust federal loans first before moving to private loans, just because of the available options under the federal loan program for repayment and rehabilitation in particular that aren't available under the private program.
Mr. Lyons, followed by Mr. Bernier and Ms. Everly. The agencies do not have public guidance tailored to private student lending. Instead, we're relying on an interagency policy on retail credit that was last updated over 13 years ago. Some have suggested that this guidance prevents private lenders from granting appropriate relief to struggling borrowers. What flexibility do lenders have in working with borrowers to prevent default, and what additional steps will your agencies take to provide clear, up-to-date loan workout guidance for private student lenders? Mr. Lyons.
Senator, the interagency guidance, as you said, was prepared 13 years ago. The OCC in 2010 provided some additional guidance to our examiners, which addressed forbearance, workout programs, and so on. And it was really driven by the fact that banks were not properly recording transactions, workout transactions, and forbearance transactions on their books. So we provided examiners with clarification and further guidance. And as I said, that was in 2010. Having said that, banks, and we continue to encourage banks to work with customers. There's nothing in the guidance, either the Uniform Retail Guidance or the OCC guidance, that prevents a bank from working with a customer. The bank, however, does have the responsibility of properly recording that transaction on their books.
Mr. Vermillier, do you have anything to add?
So the retail loan classification guidance is very broad in nature and articulates timeless principles of risk management. It is not a prescriptive piece of guidance. It does not declare certain types of things out of bounds, but instead encourages banks to work with their borrowers when they can reaffirm the ability and willingness of the borrower to repay.
Ms. Everly.
I believe that the retail credit policy guidance does offer institutions the flexibility to work with borrowers, and in fact, the institutions that the FDI supervises have used that flexibility and offer a range of workout programs. The one that I highlighted earlier was a differing range of forbearance after the initial 6-month grace period. It ranges from 3 to 9 months in the institutions we supervise. So we have not set forth anything concrete or prescriptive, but our institutions are using the flexibility and the guidance in the way that it was intended.
Senator Crapo.
Thank you, Mr. Chairman. Mr. Chopra, last month the Bureau published a report on the effects of student debt on young people's economic futures, and in that report you make several policy recommendations, including spurring a more robust refinancing market, offering more relief options, and a possible credit report clean slate program. It's my understanding that some of these proposals may require legislative changes. Have you heard from the lenders and the regulators about the merits of these programs, and do you believe that the lenders currently have the tools and legal authority to participate in these programs?
Well, all of those suggestions that we put forth in the report were a summary of public comments that we receive, and many of them, in fact, would not require legislation. In order to maximize the value of a troubled loan portfolio, banks and other financial institutions generally go through the process of identifying interventions that would increase the net present value of those loans. As the other panelists have mentioned, restructuring those loans is something where safety and soundness, as well as helping borrowers, seem to go hand in hand. And I share the concern of many investors, both equity and debt, who would like to see financial institutions maximize the value of these portfolios. It also ensures that those customers become lifelong loyal customers and can continue to bank with that institution, borrowing mortgages, auto loans, and other things that may provide higher net income to that institution.
Thank you. And for the other regulators, I've heard from many lenders that they are willing to offer more relief options. However, if the lender does modify a student loan, then they have to account properly for modifications on their books under the GAAP accounting standards. And a high number of modifications could signal to the prudential banking regulators that the lender's loan portfolio is not safe or sound. Thus, we have a situation in which the CFPB is advocating for certain relief options that may not be possible under current guidance and prudential banking regulations. First of all, is that correct? And how can lenders offer loan modifications without running afoul of the safety and soundness and accounting standards that they now must qualify under or must pursue? Mr. Lyons?
Senator, we encourage banks to work with customers when they have financial hardships. That would be reflective in the portfolio regardless of whether they did that or not. So whether it was a TDR or not, you would probably have a past due loan and a delinquent loan. So the risk would still be identified in the portfolio. So we encourage banks to work with customers before they get to the point where it's severely delinquent. Banks do have the flexibility of offering a number of different programs, but as we did say, they are responsible for accurately reporting those transactions on their balance sheet. They have a fiduciary responsibility to their depositors, investors, and shareholders that they accurately report the risk profile of those portfolios.
Thank you. Mr. Vermillier?
So very similar. We expect our banks to work with borrowers in a way that benefits both the bank and the borrower. A restructured loan that is performing is far better for everyone than a severely delinquent loan or a charge-off. We also expect banks to follow basic principles of sound risk management. Typically, for a bank that has a large portfolio of restructured loans, we would expect them to segregate these loans from others on their balance sheet and then monitor the risk characteristics of this portfolio, understand the probability of default, understand the loss-giving default, and then hold appropriate reserves and capital. If a bank could demonstrate with their data that these loans performed in the same way as past credits, then that would be a perfectly appropriate outcome. But we always expect banks to follow accounting guidelines as well.
Thank you. Ms. Eberly?
I would agree with everything my fellow panelists have said, that when you have a troubled debt restructuring, you by definition have a troubled debt to begin with. So the actual accounting designation of a TDR really doesn't impact the examiner's view of whether or not the debt was troubled to begin with. It does impact the examiner's view about the bank's ability to work with that borrower and turn a problem situation into a better situation. By definition, a troubled debt restructuring indicates that the bank is working with the borrower, taking a bad situation and trying to find a way out. It is important that our examiners do take a look on the back end, as Mr. Vermillion noted, of an institution's results with their troubled debt restructurings, with their modifications, to make sure that modification programs are reasonable and are ending up in a result that is good for both the consumer and the bank.
Thank you. Thank you, Mr. Chairman.
Senator Reid.
Thank you very much, Mr. Chairman. Mr. Chopra, you are responsible for coordinating with the Department of Education, and also you are responsible for reviewing the services. Is that correct? The people who are servicing these loans?
Yes, the Bureau has a number of initiatives with the Department of Education and has supervisory authority over large financial institutions, over $10 billion in assets for consumer financial laws with servicing operations, as well as we've proposed supervision of certain large non-bank servicers.
But let me ask a question. To what extent are these loans held by servicers in sort of trust arrangements, as was common with mortgage securities, or held directly by financial institutions so that they can, in fact, negotiate with their customer directly?
Yeah, so in private student loans, I would say roughly half are held in ABS trusts, where there is a master servicer and appropriate guidelines in governing those changes to the notes would apply. A key difference between subprime mortgage, MBS, or private student loan ABS is that it appears that the servicers, generally speaking, have more discretion, relatively speaking, in the mortgage world, of conducting certain interventions that may maximize the value for those debt investors.
Are they taking those advantages from your perspective now as you get ready to regulate them?
Well, our oversight solely relates to consumer financial laws. There is certainly activity to restructure certain loans within certain players that hold that service asset-backed securities whose underlying assets is private student loans. But I think in general, the activity of modifying or restructuring debt that may be in the best interest of the debt investor and the borrower is troublingly low.
Troublingly low. Thank you. Mr. Lyons, do you supervise both the banks and the services that are part of the holding companies you supervise? How does that?
Well, if it's conducted in a national bank, we do supervise the national bank's activities, whether it's on the bank's books or if it's being serviced by the national bank. We'll look at that activity as well.
Is it common for banks to maintain a loan on their books as performing because they hope ultimately to collect something since these loans aren't dischargeable in bankruptcy?
Student loans are not dischargeable in bankruptcy. That does not mean that the bank should not, under certain circumstances, show impairment or charge that loan off if it's not performing.
But do they routinely show impairment, or do they assume that, one, they will collect eventually?
No,
under accounting rules, can they?
Under accounting rules that we enforce, we expect the bank to show impairments and to take charge-offs when they become past due over 120 days, regardless of whether or not there's a
and what is the general record of impairment of student loans today in the institutions you supervise? High, low?
So there's 8 banks, 8 national banks that conduct private student lending. Each one of those banks has engaged in some type of workout or forbearance. The number is not very large. Okay, the performance in those portfolios has been pretty good. As we said earlier, the past due rates are generally in the 3 to 4% range, and the loss rates are generally around 4 or 4.5%. So the performance has been relatively good.
That is of this vintage loans.
That's the entire portfolio, so that would cover all vintages.
Okay. And is there any difference between those loans held by the institution and those held by a servicer or affiliate of the institution?
I'm not sure what the servicer portfolios, the delinquency rates there are. What I quoted you was what's on book.
Mr. Vermillion, how about the servicer portfolios? Since the holding company, would presumably be a holding company subsidiary, are you noticing high levels of default or high levels of modification?
So the data that we have is very similar to that cited by a colleague from the OCC. We don't have data that distinguishes the delinquency and default rate for loans where the servicer is separate. We can follow up on that.
Please do so. But again, I just want to confirm, Mr. Chopper, from your perspective, your point was that you're not seeing the kind of modifications numbers that would follow from the loan crisis that you're seeing in terms of delinquencies. Is that a fair statement? I don't want to.
There's, of course, usages of forbearance, as the other panelists have mentioned, but I don't think there's a significant amount of concessions given by lenders appropriately noting that in their accounting statements and then redoing the loan. It's a very low volume.
Thank you.
Senator Warren.
Thank you, Mr. Chairman. As we've seen in recent studies, and as some of our witnesses have testified today, private student loans carry high interest rates. They're difficult to restructure, and in many cases, they have created a barrier for people trying to buy their first homes. And that's why I was surprised that a Federal Home Loan Bank has been making available an $8.5 billion line of credit to the nation's largest private student loan company, Sallie Mae. The Federal Home Loan Banks were established to expand home ownership, but now it seems that they are undermining that goal by helping finance more student loan debt. In addition, the Federal Home Loan Banks get extraordinarily cheap access to capital thanks to government sponsorship, and that cheap capital was provided to Sallie Mae. And let's be specific on this. Sallie Mae has been getting this line of credit for 1/3 of 1% interest, and then turning around and lending money to students at a rate about 20 times higher than that. So yesterday I sent a letter to FHFA Acting Director Ed DeMarco because he regulates the Federal Home Loan Banks. But you're all experts, so I want to ask you about this too. Does it make any sense for a Fortune 500 company that makes high-profit student loans to be able to borrow money for less than 1/3 of 1% from a program that has federal backing for home ownership? Mr. Lyons, how about if we start with you?
Senator, the OCC does not regulate
I understand
Sallie Mae,
that.
so
I understand that.
I'm not familiar with that program.
But I'm asking you the fundamental question. They're getting money at 1/3 of 1%.
Right.
And then turning around and lending it to students at many multiples of that.
So, Senator, in national banks, can I please speak to national banks? The rates that the national banks are charging for private student loans today are comparable to what are being charged for federal loans. So there is a spread there. National banks are offering rates LIBOR plus relatively the same as federal loans. So
you're telling me it's like federal loans, which this year will make $51 billion in profits for the federal government. I'm not sure I find that reassuring. Ms. Burley, you have any comment on the question about the Federal Home Loan Bank Boards lending to Sallie Mae at 1/3 of 1%?
So I think the issue you're raising is a public policy issue. The Federal Home Loan Bank is authorized to make loans that are secured by the former federal loan program collateral, so loans that were issued by institutions with a federal guarantee. So that is allowed under
I'm not asking the question whether or not they behaved illegally. I'm really asking the question if they're there to promote home ownership. I think we have heard from our witnesses today that home ownership may be undermined, that there's data suggesting that home ownership is undermined by the growing amount of student loan debt. And so I see the Federal Home Loan Bank Board seems to be heading in opposite directions at the same time. Mr. Chopra, you have any comment on this?
I have no idea.
Hit your button.
Oh, I'm sorry. I have no idea about that, the appropriateness of that arrangement. It is true, though, that data would suggest that student loan borrowers are now less likely to have a mortgage.
All right. Well, that's a helpful point in it, but really worrisome about the policy that we're following here. Let me ask another question. I understand when we first started why we called student loans subsidized, but this year the government will profit $51 billion from the student loan program. The new loans will make a profit of $184 billion over the next 10 years. And it turns out that even the so-called subsidized loans make a profit of about 14 cents on the dollar. The student interest rate is scheduled to double July 1st. And so the question I have is, why do we call these loans subsidized? I don't get this. Why are they called subsidized? Mr. Lyons?
Senator, you're referring to the federal program that the national banks don't lend into. They lend into the private market, so I'd be happy to discuss the private market.
I take that as a no. Mr. Chopra?
Well, the reason why it is called subsidized is because in the old bank-based program where they gave federal loans that were guaranteed, the government paid subsidies to the financial institutions for interest accrued during periods such as being in school.
Are we doing that anymore?
No, that program has ended.
So we call these subsidized loans, even though today the program has been completely changed and in fact is making a profit for the U.S. government. So I just want to say, this just seems wrong to me, Mr. Chairman. The government lends to banks at 3/4 of 1% interest, then does a huge markup on student loans, will make $51 billion in profits this year. Sallie Mae borrows at 1/3 of 1% in a program that is supported by the federal government and then does a markup on student loans. It's time for the government to stop making a profit off our students. Thank you, Mr. Chairman.
Senator Brown.
Thank you, Mr. Chairman. Mr. Chopra, give me your thoughts on our refinancing refi for the Future Act and answering some of the questions and concerns on the $150 billion outstanding dollars and for the future, what this means for private bank loans?
So without knowing specifics, I can say that it is absolutely important that we address the large population of existing borrowers and not just the new borrowers. Many of those existing borrowers were certainly victims of a financial crisis that they played no role in creating, and they wonder why they've been unable to take advantage of today's historically low rates. And just as in 2008, there were market failures that provided for temporary authorities to ensure financial institutions could originate loans. There's no authorities currently to jumpstart that sort of market. So it seems that it's worthy of very careful consideration.
Thank you. This is for all of you. Student loan debt, as a number of people have pointed out, Senator Crapo and the chair and others, that is the second largest form of consumer debt behind mortgages. And I see some similarities between these two issues, these two lending institutions in some sense, if you will. The biggest banks we hear repeatedly, finding out more information last week, are doing a generally poor job complying with the national settlement over their improper foreclosure practices. Homeowners have had some of the same problems that responsible student loan borrowers are having. They can't refinance, they can't negotiate a deal for an alternative repayment arrangement with the institution with whom they have their mortgage. But some large financial institutions are at least trying to pursue some mortgage modifications to stem their losses. So, but with the student loan market, it doesn't seem like that refinancing is happening with very, very, very few exceptions. Despite the Federal Reserve's testimony, quote, that student loan modifications are generally in the best interest of both the institution and the borrower, can lead to better loan performance, increased recoveries, reduced credit risks, and that they'll view such modifications as a positive action when they mitigate credit risk. So even though the regulatory bodies are saying this makes sense for banks to begin to refinance some of this $150 billion in outstanding student mortgage debt, why? I understand this is a small portfolio for Citibank or for some of these large institutions. The student loan market is not very large relatively for them. But each of you answer, why are the banks not willing, when regulators are saying this makes sense, when common sense suggests that this makes sense to refinance, why are the large banks simply not coming to the table to refinance these student loans? I'll start with you, Ms. Redmond.
Certainly. Yeah, it's a good question why there's not an active refinance market for student debt. There's nothing in regulatory policy or practice that prohibits borrowers from refinancing their student debt. None of the institutions that FDIC supervises uses prepayment penalties or anything that would prevent a borrower from actually engaging in a refinance. Part of it may be that the interest rates relative to other unsecured consumer debt available through banks is actually priced a little higher than student debt is, so that may be one factor. The underwriting criteria used by the institutions that FDIC supervises usually requires a guarantor, which means the debt is underwritten at a rate that reflects that you've already got an established borrower listed on the debt. So you may be starting out with a low rate to begin with based on that established credit history as opposed to a student on their own. So that doesn't address any maybe legacy loans that are outstanding that are at higher rates of interest or that weren't guaranteed. So it is unclear why there's not an active market to meet apparent demand. So I think the proposal is very interesting. It's something we'd be interested in working with you on.
Mr. Vermillion, I mean, sort of this issue of too big to fail with these largest banks. It's coming back again. Is this sort of a too big to care sort of situation with these large banks with a relatively smaller portfolio? They're just sort of disdainful of doing anything with refinancing student loans?
I don't think it's too big to care. I think they're interested in profit opportunities where they can find them. I would associate myself with the response from the FDIC. It's not clear why this isn't happening more. Our regulatory policy would certainly permit it and indeed encourage appropriate workouts. like the FDIC, we're interested in exploring this further.
Mr. Lyons.
Senator, I would echo the comments of my fellow regulators. I think also it may reflect possibly some market inefficiencies, lack of competition, as well as Ms. Everly said, many of the student loans, private student loans today are priced off of a cosigner, so they are actually at a lower rate than would normally be the situation. So, you know, that may also factor into why we're seeing low refinancing opportunities.
Chopra.
Well, as you mentioned, net income from private student loans is a very small fraction for large financial institutions. And as we note in our report, many of those financial institutions, senior management is still addressing legacy issues of troubled portfolios, particularly in the residential mortgage space, that may be occupying significant management bandwidth, as well as their issues with the flexibility and agility with their IT and accounting systems.
All right. Mr. Chopra, your comments earlier about, you know, the establishing, what puzzles me further about this that you mentioned earlier was that these large these institutions that are simply not, that seem indifferent to, if not hostile to, refinancing are the same institutions that I would think would want these young people who owe them this money to be lifelong customers and get a mortgage someday when they can pay off their student loans and start businesses and all the things and use these banks with whom they have a relationship. But that doesn't seem to be the case. Thank you, Mr. Chairman.
Senator Merkley.
Thank you, Mr. Chair, and I'm going to start by addressing something else. We were sitting here, the Supreme Court released a ruling eviscerating the Voting Rights Act, and I'm deeply disturbed about that. The strategy of voter suppression has been used against blacks, Latinos, elderly, the poor, immigrants. We had a situation in our history where New York City politicians held registration days on Jewish holidays to keep Jewish individuals from voting. We have had all kinds of forms of efforts to not embrace the full ability of citizens to participate in our democracy. And today we have strategies that include voter ID laws, the reduction of early voting hours, the drawing of discriminatory districts. And so we are not in an era free of a strategy to block people's ability to participate as full citizens. And I think it's deeply disturbing. The 5-4 decision that just came out is deeply disturbing. The topic we're addressing right now on the cost of student loans, it seems like we have a new form of debtor's prison for our students because the loans in combination with the interest rates means individuals are having to delay living independently, delay marriage, if they can't get a loan to buy a house, or if they do, their credit score because of the debt that they carry is higher, so they have to pay a lot more in interest to buy a home. Can't get a loan to start a business, may be disadvantaged in employment interviews. All of these are factors that compromise one's ability to thrive. And one of the pieces that's disturbing to me is these private loans vary their interest rates according to the credit background of the applicant, even though the loans are guaranteed, which means that if you come from a background in which you have less wealth, you are going to have to pay a higher price over a very long period of time to get an education, thus locking in inequities from one generation to the next. Are any of you disturbed by that bias in the system, and if so, what do you think we should do? Doreen or Ms. Eberle, perhaps we can start with you.
So I may have misunderstood the question, but the private student loans that we have supervisory responsibility for, the lenders that make those loans share a similarity with federal student loans in that they're not dischargeable in bankruptcy, but they are not guaranteed by the government. So that is a key distinction. So the institutions bear the risk of loss for a default on those loans. Institutions are offering, the institutions that we supervise are offering a choice of either a variable or a fixed rate of interest at the onset of the lending agreement. So the current variable rate of interest ranges between 3 and 9%, the fixed rate between about 5.5 and 11.5.
Is it fair to say someone from a background where they have less wealth, less assets, is more likely to pay the 9% than the 3%, and therefore pay a much higher price for their education?
So it is true that an individual that had a less strong credit history would pay a higher rate of interest.
So yes. The answer is yes.
It's risk-based, yes, based on the individual's credit history.
Okay. I take your point on the national guarantee, and thank you for pointing that out. Does this bother anyone else?
Well, Senator Merkley, the private student loans are often underwritten to the FICO score and income of a cosigner. So for borrowers whose parent, say, is not very creditworthy, they in fact would have a higher rate when they were freshmen. And I think that many of them wonder, once they do graduate and land a very good job, they wonder that given that their risk profile may have considerably shrunk, they have developed their own credit history, why they're unable to find a product in the market that is a lower risk-adjusted price.
And they wonder about that because they're not able to refinance.
That's right, and I think many of them see the incredible savings that perhaps their parents who may be homeowners who've been able to refinance given today's historically low interest rates.
Does this system in general, as we've described it here, create extra hurdles for those who come to the education marketplace with poor assets?
Well, there's certainly issues with market efficiency when when price does not seem to match risk, which seems to be an issue.
Mr. Lyons, is there a bias that reinforces differences in background?
Senator, I don't know that answer. I would echo what Doreen Eberly indicated, as we expect banks to risk price. They do risk price to the extent a student utilizes all of his federal grants and loans and then has to move to a student loan, private student loan. That loan would be risk priced.
If you have a loan that's 9% versus one that's 3%, would it be fair to say that by and large the cost of the loan is going to be 3 times as high?
Not necessarily 3 times, but it will be more expensive, yes.
The interest rate would
yes.
be 3 times as high.
The interest rate is 3 times.
And thus, a low-income student, a student with parents who are co-signing who have a poor credit background, might pay 3 times as much in interest over the course of the loan.
To the extent it's a higher risk, the bank would charge a higher rate of return, yes.
Thank you. Thank you, Mr. Chair.
Senator Heitkamp.
Thank you, Mr. Chairman. Just a couple points, and I don't remember if it was Mr. Lyons or Mr. Vermillier who gave us the side-by-side comparison, 2004 to today. I think it was you. You might want to add another statistic to your record there. 55% of all private loans in 2005 had a cosigner. Today it's 90%. We're not only mortgaging our kids' future, we're mortgaging their parents' future, their grandparents' future, and we're putting their home ownership and their retirement at risk. This is a big issue, the issue of co-signing, and so I just raised that because I think it's important to put that on the table. A couple issues, one on transparency and one on a recent visit that I had in North Dakota where I had a chance to sit in the car and actually listen to the radio. And this is for Mr. Chopra. Have you seen the 1-800 numbers or heard the 1-800 numbers? Get yourself out of student debt trouble. We're here to help. They sound a lot like the predatory lending that we've experienced over the last how many years with home mortgages or consumer debt, credit card debt. And I see an entrance now, an opportunity to move into that market by people who are engaged in predatory lending practices. And I'm wondering if you guys are monitoring that, paying attention, if there's anything Congress should be doing right now to educate students, but us to get out ahead of it on a regulatory basis?
Well, we're certainly familiar of the increase in debt collection and debt relief activities as the conditions in the student loan market for many have been quite challenging. For borrowers who have federal student loans, they are marketed services to pay a fee to enroll in certain programs that may help them get out of default through the Department of Education, which may be at no cost. So, of course, we are looking to educate consumers and ensure that all financial services providers are complying with the law.
Just to follow up, one suggestion that I would have, and I know budgets are limited, but the ability to advertise on the same platform, to educate on the same platform is critical, because what they're not advertising to kids on, 790 talk radio, they're advertising to those parents who have co-signed those loans. And that's a big concern that I have. I want to, Mr. Lyons, you raised a very important point, I think, on transparency. Anyone who recently has had a mortgage has sat down for almost an hour and a half and done all the due diligence, signed all of the, awareness. Yes, we know we're mortgaging away our life. Frequently what happens to a kid and their parents on student loans is that the paper gets slid across the desk and sign on the bottom line if you want a better future. And for a lot of, especially first generation college goers, there isn't maybe a level of sophistication on what the alternatives are. And so I'm wondering if anyone on the panel, but particularly you, Mr. Lyons, since you raised the issue, have some suggestions for what we can do to promote more transparency in the private marketplace, and whether that should be mandated, encouraged, or otherwise talked about.
Thank you, Senator. I would agree with the recommendations that the CFPB put forth regarding disclosure and clear transparency.
But how do we get banks to do that?
And I think banks have taken steps over the last several years since the crisis to improve transparency. And so there is discussions before, during, and after that they provide the students and the student's family, whereas in the past that may not have been the case.
One thing I would suggest, and my time is short, and that's why I'm interrupting, and I'll follow up with some additional questions, but this needs to be done in conjunction with institutions of higher learning. I have a student right now in North Dakota who has $100,000 of private debt. He's a first-generation student. He has a music major, and he's living in his parents' basement. His parents, I'm sure, are on the hook for that same level of debt. He'll never retire that debt. He'll never get out from underneath it, and we've guaranteed that by not discharging this debt in bankruptcy. And so with a little bit of education about, what that education is worth compared to earning power into the future, and what we need to do to educate kids not only as they pursue their dreams, but taking a look at what the earning power are of the choices they make in terms of education opportunities. And so I think you're only one part of the problem. I wouldn't say problem, but you're only one part of the solution, which is, here it is, financial literacy, but back it up with also education on what the earning potential is for these students, and maybe banks can be part of encouraging that as well. Thank you, Mr. Chairman.
Senator Manchin.
Thank you so much, Mr. Chairman. We were talking about public policy, and I'd like to get your input since you're part of the public. I think you're hearing from all of us that we believe that education being, and the facts are overwhelming, that education adds to the value of not only the person, their well-being, their families, their communities, their state, and the nation. We all, I believe, have that agreement. We're all products of it, probably. With that being said, is your opinion that we should not make a profit on education when it comes to loans? That's a public policy. We've got to make that. We need your input. So if I can just start with you, ma'am.
Well, in the, so I'm not sure if you're talking about in the federal sector.
I'm talking about
private
every
sector.
public policy. Do you believe public policy should be that profits should not be made on education loans of any kind? So if we can just kind of pay itself and break even, or do you put the same procedures and the same policies in place as you do any other type of loans?
I think it's an interesting question, and I think you'd have to differentiate between the federal sector and the private sector in answering that question. Well, in the private
It's public
sector,
policy, it's public policy.
Yeah.
So maybe your cost is a little different. Maybe your whole policies are a little different. but there's still a spread. There's a spread taking a lot of things in consideration. Do you believe that spread should be zero or minimized to the point to where there's no? I'm just asking a simple question.
I think it would be hard to calculate a zero spread on the private side just because the institutions bear the risk of loss. So there's not the government guarantee.
You don't have a public opinion then on.
So it's really not my area of expertise. And
you have an opinion. You're public. You have representatives, Congress, and the Senate. What would you say to your congressman and senator?
I'd have to think about it. I haven't thought through this.
In the private markets, we need to take many factors into consideration. One is credit availability.
I think I'm just asking a simple public policy. Do you believe, here we sit, do you believe that we should not make a profit if we can keep from making a profit on trying to educate this great society of ours?
My concern would be that if there were a mandated zero spread, for example, that there may not be credit availability in the public.
So you're saying that basically in the private sector, that the almighty profit on every aspect of life is going to prevail. I'm a private business person. I'm just saying you have to put your priorities where your values are. If education is what's built this country, education has this is the greatest country on earth, how do we get there? And have we left that premise? And is everything the almighty dollar, the bottom line, to the point where we're trying to educate the masses? It's a public policy. You're talking, I'm your senator. What do you want me to do?
So education policy is not in the remit of the Federal Reserve, and the governors have not spoken on this issue, so this is a matter for Congress.
Now you know why we have a stalemate in Congress now, because we can't even get the public to engage. And I know you're looking, and you have to be careful what you're saying. I'm just trying to get input. Sir?
Well, I'm not going to expand the discussion much further, Senator. I don't think it's appropriate for a prudential regulator to take a public policy position. Having said that, I think I would echo what the two other regulators indicated, that it would be difficult to attract capital to a business that doesn't provide some profit to the investors. And you think that's just a consideration.
You think that basically the American public and the investors in American society would not invest in education knowing that it would be a zero return?
I think that's a possibility that has to be weighed.
Ms. Schopel.
Well, Senator, I agree with others that investors will not be able to earn a return on equity if they cannot earn any margin. But as it relates to your general question of profitability, the only thing I can add is there is data from a number of sources that does suggest there are positive externalities of a highly educated workforce in the sense of global competition, wage growth, and others, and certainly policymakers may consider that when developing policies to promote a highly educated workforce.
Yeah, I'm talking in primary and secondary education. We're mandated by the Constitution in most every state to subsidize and pay for, which I agree wholeheartedly, and we all do that willingly. Higher education, there's not a word in my Constitution in West Virginia that says that we have to give a penny towards that. So our founding fathers a long time ago thought this was a high value, good return, and we got involved, and we do. We're talking about a financial program that doesn't cost. We're not subsidizing. We're not asking someone to pay. It'll pay for itself. Should we remove the profit where possible? And I think that's where Senator Warren, all of us, now can we find that balance somewhere to where we can all be satisfied that you can still have enough money that we can keep the program alive, but we still have taken the amount of profit out that it puts the burden on the backs of productivity. I think that's it in a nutshell, and that's where we're coming to. And we've got to, since we're not getting much help from the input from our constituents, we've got to be able to cipher through this one to find a balance between our colleagues on both sides of the aisle. Thank you, Mr. Chairman.
I want to thank our witnesses for their testimony today and for their hard work on this important issue. This hearing is adjourned. Good morning. I call this hearing to order. For many Americans, a college degree is an important goal that can mean a lifetime of better earnings and opportunities. However, this goal has come at a higher price. The cost of education has risen significantly while the job market has weakened, straining a generation of Americans seeking to establish themselves in the broader economy. Student loan debt now stands at over $1 trillion and is second only to mortgage debt as the largest form of debt in the country. Student loan balances have almost tripled since 2004, and an alarming one-third of borrowers are delinquent on their loans. Last year, nearly 8 out of 10 students in my home state of South Dakota graduated with student debt. These rising debts reach beyond individuals and impact many sectors of the economy. High levels of student loans mean many put off buying a home or never become homeowners at all. Student loans make it harder to start small businesses. Student loan payments often take priority over retirement savings. And rising student loan balances in states like South Dakota make it harder.
Here is that banks don't offer enough borrower relief options. In the testimony submitted today, it appears that prudential banking regulators and the CFPB are offering conflicting guidance on borrower relief options. The CFPB is pressing for more borrower relief. However, the prudential banking regulators are concerned with how modified loans affect a bank's safety and soundness, as well as whether they violate accounting rules. Lenders have stepped up and expressed their willingness to help more troubled borrowers and cite that loan modifications may benefit both borrowers and lenders in certain circumstances. Today, I hope we can get a better understanding of the obstacles that face us directly from the regulators. I also would like to hear about how the regulators are working together to resolve this conundrum of providing student loan relief while not endangering the safety and soundness of the system. Finally, since the vast majority of student loans are made by the Department of Education, we need to acknowledge that the Committee on Health, Education, Labor, and Pensions has a critical role in determining whether the Department of Education's student loan programs are helping the situation or binding students and their families into too much debt. I know all my Senate colleagues want to find a solution to ease the burden on our young people. Mr. Chairman, before we conclude, we received a letter from the Consumer Bankers Association and a letter from the Financial Services Roundtable regarding student loan issues, and I would request that both letters be entered into the record.
Without objection.
Thank you.
Thank you, Senator Crapo. Are there any other members who wish to make a brief opening statement?
Mr. President.
Senator Reid.
Thank you, Mr. Chairman. Thank you very much for holding this hearing. And we are reaching a tipping point with student loan debt, as you've and Senator Crapo have illustrated, particularly as we approach July 1st with the potential doubling of loans on students who have the most need in our country. Student loan debt, as both my colleagues have indicated, is really the next big financial crisis, and it could have a lasting impact on our economic growth and the perspectives for coming generation. We've seen student loan debt.
Crapo.
Thank you, Mr. Chairman, for holding this hearing today. Student loans play a vital role in the lives of many students and their families across this country. The loans help maintain a strong and educated workforce by ensuring that all Americans can have access to higher education, regardless of their financial circumstances. Recently, the New York Federal Reserve reported that student loan debt has risen to become the second largest household debt burden behind mortgages. The total outstanding student debt was $986 billion in the first quarter of 2013. Just 9 years ago, that number was $240 billion. Several factors have contributed to this student debt explosion over the last decade, including college tuition rates that have significantly outpaced inflation, and a record number of students and employees opting for school in light of the very tight job prospects in the market. When discussing the student loan market, there's considerable confusion as to who is making the loans and how the loans are made. According to the CFPB, 85% of the total outstanding student debt is in federal student loans offered through the Department of Education. That is roughly $838 billion. Private student loans, the subject of this hearing, make up 15% of the outstanding debt, and that market is expected to shrink even further. A recent Standard & Poor's report noted that new originations for federal loans occupy roughly 94% of the market, while private lenders originate the remaining 6%. Much of the contraction in the private lending market is due to the restructuring of the Department of Education loan programs in 2010 to virtually eliminate private lenders. Other important considerations include the fact that federal loans default on average 3 times as often as private loans. Federal loans do not undergo an underwriting process, and there is almost limitless spending for borrowers who take out federal loans for graduate school. With respect to private student loans, one concern I often
hear for graduates to stay in rural communities. While most student loans are federal, private loans make up $150 billion of the market. Private lenders allow many students to attend college who would not otherwise be able to afford it, and may sometimes offer better terms than federal loans. However, nearly 1 million borrowers are in default on their private student loans. And while federal loans offer flexible relief during periods of hardship, most private student lenders do not offer the same options for struggling graduates. Our witnesses today represent the federal agencies responsible for ensuring that lenders balance sound lending principles with appropriate measures to avoid default. I look forward to hearing your testimony on guidance you provide to lenders and what limitations lenders may face in providing relief. The CFPB has been very active in private student loans, recently publishing a proposal to oversee large student loan servicers and a report on affordable private student loan repayment. I'm interested to hear from the CFPB on both of these efforts. Next week, on July 1, millions of students face a doubling of the interest rates on some federal loans. I urge the regulators to be vigilant in monitoring growth in the private student loan market that may result from changes to the federal student loan market. It is critical that regulators respond quickly to marketplace changes and that consumer protections are safeguarded when demand rises. With that, I turn now to Ranking Member.
Rise throughout the recession, even as other household debt has fallen. And student loan debt, as my colleagues have indicated, is now the second largest outstanding balance after mortgage debt with respect to households. And this is affecting the life trajectory of generations of Americans, the young people today, and if we don't do anything, even their children. Our students are caught between a rock and a hard place. The job market increasingly demands post-secondary education. At the same time, college is getting much more expensive. There's been a major cost shift in higher education. Costs have gone up. State support for public institutions has gone down. And as a result, tuitions are rising, in fact, exploding. In the federal student aid program, 68% of federal student aid is in the form of loans. And I have the privilege of holding the seat held by Claiborne Pell. When Senator Pell introduced the Pell grants back then, the mix was much different. In fact, I believe it was 80% grants and 20% loans. And we have turned the whole thing over on its head. In fact, many of my contemporaries were the beneficiaries of that wonderful 80% loan to 20%, 80% grant to 20% loan effort, and we're not keeping up with that at the federal level. We have to keep these loans affordable. Low interest rates is part of the solution, and again, it is just distressing many of us that we're on the precipice of doubling the subsidized rate from 3.4 to 6.8% in just a few days. Ironically, as we increase the rates, and my colleague from Massachusetts, Senator Warren, has pointed this out again and again, the federal government is making about $50 billion this year on their loans and expected to make $180 billion between now and 2023. So there's a lot of money. It's just not getting to the young people that need it and their families. We've got to work on both sides, and we have to recognize that we have to be back where we were, I believe, in the 50s, 60s, and the 70s,